Hello and good day. From the current financial year, that is 2021, beginning from the 1st April 20, the government has come out with a new scheme and given an option to the assessee that whether they will like to pay the tax according to the old rate of tax system or whether they will like to adopt a new alternative rate of tax of system, and the assessee will have to make a choice that whether to go along with the old rate of taxation or whether to go along with the new rate of taxation. To take this informative decision, we will be going in detail comparing the old rate of taxation as well as the new rate of taxation. So here we will compare the old rate versus a new rate. The new rate has been prescribed under section 115 BAC. And the option has to be exercised either by the individual or by the HUF. So the new rate of taxation is applicable only for the individual and HUF. So now let us go into the detail. The old rate of taxation has got up to 2,50,000, no tax is required to be paid. But if a person is a senior citizen, that is between the age of 60 and 80, then up to 3 lakhs, it does not require to pay any tax. And if the residence is above the 80, that means is a super senior citizen, then up to rupees 5 lakhs, it does not have to pay the tax. Subsequently, the starting rate of taxation up to rupees 5 lakhs is 5%. From 5 lakhs to 10 lakhs, it is 20%. And 10 lakhs and above, it is 30%. But you will be noting down an asterisk mark which has been put between the tax rate of 5%. Now, what is the implication of this noting mark? Now, the implication of this noting mark is that section 87A prescribes that any individual resident in India, if he has got income up to rupees 5 lakhs, he did not pay any tax. But once an income exceeds rupees 5 lakhs, then the above rate of taxation on the table is applicable. Now let us compare this one with the new rate which has been prescribed by the government. But however, we have to keep in mind before we start the comparison with the new rate that under the old system there are number of the deductions which are available, and due to this deduction the rate of taxation effectively can be brought down. Take an example, most of you people must be investing in the NSC or LIC, or maybe paying a housing loan, or maybe meeting in children education expenses, and all of the deductions which are available under the ATC up to rupees 1,50,000, you are not required to pay the tax. That means effectively for you the tax rate 2,50,000 plus 1,50,000, that makes a total of 4 lakhs. You don't have to pay any tax. Then if you are having an income from the salary, you get the standard deduction of 50,000. So up to 4,50,000, again you don't have to pay the tax. You add another 50,000 if you are investing in the pension scheme. Then up to 5 lakhs, you are not required to pay any tax. And then the tax rate starts from 5% onwards. Now if you are having a housing loan, then you can add another 2 lakhs. So in this particular manner, this limit goes on increasing, and up to 9,50,000, believe me, as we will understand in the progress, that you are not required to pay any tax. Now let us understand this vis-a-vis the new system and the new rate of taxation. The new rate of taxation does not make any age difference. That means it is applicable at the similar rate for all the citizens, whether he is below 60 or whether it is 60 to 80 or whether it is above 80. So up to 2,50,000, there is no taxation. Subsequently, the taxation start at the rate of 5%. That means compared to the existing system, if a person is above the age of 60 under the existing system, he get the tax-free limit up to rupees 3 lakhs, but under the new system, he will get only up to rupees 2,50,000. And in the case of the above 80, it will again up to 5 lakhs. But again, we have to remember that section 87A prevails in the old system as well as in the new system. And because of this, up to rupees 5 lakhs, if you are having an income, you are not required to pay any tax. But however, if your income exceeds rupees 5 lakhs, then the rate of taxation is payable from 2,50,000 onwards. So here under the new rate, at least if your income is up to rupees 5 lakhs, you don't have to worry. But if it exceeds rupees 5 lakhs, you have to think of that, keeping your age factor into mind, whether you should go for a new rate of taxation or whether you should go for a old rate of taxation. Because under the new rate of taxation, the tax is 5% up to rupees 5 lakhs. Then from 5 lakhs to 7,50,000, it is 10%. From 7,50,000 to 10 lakhs, it is 15%. From 10,50,000 to 12,50,000, it is 25%, 20%. From 12,50,000 to 15 lakhs, it is 25%. And above rupees 15 lakhs, it is 30%. So apparently it appears that going for a new rate of system is advantageous. And you must have read in the number of the newspaper that this advantage is available from right from 25,000 to rupees 75,000. And to this particular amount, if you add the 4% cess which is there, then the exact benefit will vary from 26,000 to 78,000. So the rate of taxation, you have to compare that. Yes, apparently there is an advantage of going for the new rate of system. But like any scheme which gives you certain concession or certain benefit, it comes with a small asterisk mark, and that is terms and condition applied. And you being an intelligent people will definitely like to understand this asterisk mark or the terms and condition applied before going for an new rate of taxation, and you will like to decide that under which circumstance you should take the benefit of the scheme and under which circumstance you should stick with the old scheme. The reason, and what is that asterisk mark? That asterisk mark on the terms and condition apply is that you have to forego nearly 70 plus deduction. That means there are a number of the deductions you will have to forego if you are opting for the new rate of taxation. Now let us understand which are the deductions which needs to be forego. So now let us understand when this option need to be exercised, and once you exercise this option, what are the implications of the same. So first we will focus upon the non-financial aspect. So here it says that if a person is having an income from business and profession, then he has to, before filing the return for the previous year ending 31st March 21, as per the provision of section 139. Normally, what is the due date? Up to 31st July 2021 or 30th September 2021 under certain circumstances if the tax audit and other things are applicable. So all the businessmen has to decide about this option at the time of filing the income tax return. Once this option has been selected, he has to keep in mind that he will have to stick with this particular option throughout his life, and he is permitted to change it only once. And once he changes, that means once he moves out of the scheme, he cannot re-enter for the benefit of this particular provision. And for all other, the same is a due date like above. But however, if you are having an income from salary, a TDS is required to be deducted. And for that reason, you must tell your employer, before the employer start deducting the TDS, that whether you are opting for this particular scheme or you are not opting for the particular scheme. And if you don't intimate, it will be presumed that the old scheme continues. That means you have selected not to go for the new scheme. However, this option can be selected anytime before the filing the income tax return due date, which generally will be 31st of July 21. But for TDS purpose, you will have to intimate the employer earlier. However, if the person is not having income from business and profession, you can determine each year. So here we have to keep in mind that for a businessman, once he decides to go for the scheme, he is bound by that particular scheme throughout his life. And he is not permitted to change, except for once, when he decides that he wants to move out of this particular scheme. But if you are not having income from business and profession in your income tax return, then you can go on deciding every year whether I should go for this particular scheme or I should not go for this particular scheme. So any assessee may be deciding that, okay, in 2021 I will go for this particular scheme. In 21-22 he will decide that I will not go for this particular scheme. Again he may decide that no, I want to select the scheme. So as far as you are not having income from business and profession, you can go on coming in, coming out. But for business and profession, once you are in, you cannot come out, and once you come out, you cannot go in. So to that extent, there you can say it is a loop-sided again against a person who is having an income from business and profession and is disclosing that income from business and profession. Once the person go for this option, then he has to forego nearly 70 exemptions and deductions. So you will be losing out all the 70 exemptions and deductions which is generally otherwise available under the old scheme. It means that every person other than the business income will have to determine the selection of the scheme every year depending upon the factual position of that particular year. And once this option has been decided, salaried person can come in, can move out, but as far as the business person is concerned, these restrictions are limited. Now think of, for a business person, if you are carrying out the business in the proprietary form or in the partnership form, then believe me, once you go through all the exemption, it is very clear that it is not worth going for this new scheme. Because you have to forego lots of benefit. Just to give an example, depreciation, which generally you claim on all the assets which you purchase. That is the one thing which has to be forgone, one of the things that has to be forgone. Then additional depreciation. Whenever you go for an expansion, you purchase a new plant and machinery, then you can go for the additional depreciation. That is another thing you will have to forego. So in that case, if you are carrying out a business in the proprietary form or in the partnership form, then that is a disadvantage. So better not to go for this option. But if you are running a business in a private limited or in the corporate entity, then definitely you will be having an income from salary. So you can have the advantage of a private limited or the corporate body also offering a less rate of taxation under certain circumstances, that is at the rate of 15% flat, whereas in this also you can take the advantage by taking the advantage on the income from your salary. So you can have the cake from both the ends. It is up to you to decide and plan out. So if you are having a salary income, now let us go forward and understand what are the things which you have to forego. Now let us understand what are the exemption and the deduction which need to be forego. But before we go into the understanding of the deduction and the exemptions which has to be foregone, we have to keep in mind the overall assessment process. That under the assessment process, if suppose your case is selected for the scrutiny, and whereby when they compare your bank statement with your income, and if they come to know that you have gone and opted for the scheme, and you have received a TADA which you have not disclosed as an income, keeping in the old situation in mind when it was exempted, and they realize that this mistake has been done, then not only they will pull you out of this existing new alternative scheme which you have gone for and asked for the concession, but because you have made a wrong declaration, you can also be liable for interest and penalty. That means you have to understand the income tax law in totality, and you have to keep in mind that you are supposed to disclose all the receipt as an income wherever exemption is being withdrawn. Especially that income has to be properly disclosed, and you have paid the tax on the same under the new alternative scheme and the new rate of taxation. So the first one, generally the major benefits which are claimed by most of the person, I will be going in that particular order, whereby most of the people are claiming certain deduction. As per the record available with the income tax department, that 80% of the people go for this particular benefits, and that benefits I'll be covering upon that this particular benefit has been withdrawn upon by the government. So first one, the leave travel allowance. The leave travel allowance, which is generally exempted under section 10 subsection 5, that means every year you may be, if you are going to the village and you are claiming certain leave travel allowances which are generally exempted, will be now considered as a taxable. Then the house rent allowance. Now if in your salary you are getting a house rent allowance and you are claiming an exemption on that house rent allowance because you are staying in the rented premises, then that house rent allowance exemption will be withdrawn under section 10 subsection subclause 13A. Then you might be getting a special allowance which are exempted under section 10(14). Then that has to be foregone. However, you are not supposed to forego the transport allowance generally granted to the Divyang employee, conveyance allowance that is still exempted, or any allowance granted to meet the cost of the travel on the tour or on the transfer, or the daily allowance. These are the exemption do continue even under the new rate of scheme. Then income of the minor is generally clubbed with the income of the parents, whether it is a fixed deposit interest income or any nature of the income which may be generated to the minor. When that is being clubbed, you get an exemption under section 10 subsection 32, and that is 1,500 rupees per child is deducted. To give an example, suppose if your minor has got a fixed deposit interest of rupees 2,000 rupees. Under the old scheme, 1,500 is allowed as a deduction, and on the 500 only you have to pay the tax. But if you opt for the new scheme, then you have to remember to pay the tax on the full 2,000 rupees without giving an exemption of 1,500. Because subsequently, if it is discovered, as I told you at the top, then you have to pay the interest and the penalty, both has to be paid. And at the same time, you will be pulled out of the exemption and you will be put in the old law. Then the standard deduction which you get under section 16, that will be withdrawn, and you don't get the standard deduction if you go for a alternative rate of tax. Then entertainment allowance deduction, if you are a government employee and you are getting an entertainment allowance up to rupees 5,000, it is exempted from tax. And the profession tax which you pay, generally up to rupees 2,500, that also will not be allowed as a deduction, and you will have to pay the tax on this profession tax income also. You will not be permitted a deduction basically. Then if you have got a housing loan and you are paying on the self-occupied property, then up to 2 lakhs it is allowed as a deduction. This also will be not, you have to forego. That means you will not get the deduction for the housing loan. So now when you compare up to this stage, the 2 lakhs on the housing loan and 50,000 on the standard deduction. So 2 lakh 50,000 deduction has to be foregone. That means if you are in the 10% tax bracket, Under the alternative scheme, under the 10% tax bracket, you get the deduction benefit of 25,000 and you forgo 25,000. So it is one and the same thing whether you remain in the old scheme or whether you go for a new scheme. So up to this stage, if you are in an existing tax bracket of 20% and then coming from 20% to 10%, apparently it doesn't make a sense unless and until you can rearrange your affairs. Then if you are getting a family pension, then up to rupees 15,000, generally you get an exemption that also has to be foregone. Then deduction under 80C, life insurance premium, tuition fees, principal repayment of the housing loan, PPF, eligible mutual fund, term deposit as a fixed deposit, etc. up to rupees 1,50,000 is allowed as a deduction under the old rate of taxation. Now under the new rate of taxation, you will have to forego this particular benefit. That means you move from 5 lakhs to 10 lakhs and you forego this particular benefit. Apparently it doesn't, if you compare in the actual calculation, you will have to do that calculation. But if you are claiming an exemption of the full 1,50,000 and at the same time under 80CCDA pension scheme, you are investing further rupees 50,000 and you are claiming a deduction of up to 2 lakhs plus 50,000 of the standard deduction. That means 2,50,000 plus 2 lakhs interest on the self-occupied. That means 4,50,000 you will have to forego if you go for an alternative rate of scheme. So in that particular case, suppose your income is up to 9,50,000. Apparently it appears, but in actual each of the case you will have to do the calculation. But if you do the calculation, there is in all probability is likelihood that you will prefer to stay with the old scheme rather than going for the new scheme, because up to 9,50,000 means up to this 150 plus 50, that is 2 lakhs, plus 2 lakhs, that is 4 lakhs, plus another 50,000 of the standard deduction, up to rupees 9,50,000. You are not paying the tax even under the old scheme. So whether the new scheme you are going to get any additional advantage, you will have to do the exact quantum of the working, but the probability is very less. Then further, you may be also claiming a medical claim premium. So another 25,000 or the 50,000 if you are also paying a premium for the parents, or if you are a senior citizen and you are paying your own premium, then up to rupees 50,000. So as I told you previously, that up to rupees, practically up to rupees 5 lakhs, there is no taxation. Plus this 2 lakhs housing loan, 2 lakhs ATC investment, ATCD investment, another 50,000 medical premium and 50,000 standard deduction. That means another 5 lakhs if you add up to 10 lakhs, practically you don't require to pay the tax. But if you go for a new alternative rate of tax, you will have to forego this 5 lakhs deduction, and on the 10 lakhs you will have to pay the tax. So kindly do the individual calculation before opting for the scheme. Then deduction under certain 80G. If you have made certain eligible donation, under the old scheme you were getting this deduction, but under the new scheme you will have to forego the same. Then deduction under 80DD and 80DDB. That means if there is a specific medical treatment which a person is required to carry out for his family member also, then up to rupees 75,000 to 1,50,000 depending upon the severity of that medical treatment or the disease or the problem which a person is facing, this deduction also will have to be foregone. That means if some person is having a handicapped child or Divyangan child, in that case up to rupees 1,50,000 deduction was available. Now that deduction also has to be foregone if he goes for an alternative rate of tax. Then if you are having a children education loan, then whatever the interest you pay on the children education loan, under the old scheme it is allowed as a deduction. But under the new alternative scheme, you will have to forego this particular deduction also. And if you are having a saving bank interest, or the fixed deposit interest under 80 TTA, 10,000 is exempted. This exemption also you will have to forego. And if you are a senior citizen, this exemption is available 50,000 under 80 TTA AA provision. So this also you will have to forego. That means generally up to 5,50,000, what you can see from this current slide, you will have to forego to go for an alternative rate of tax. Whereas under the same scheme, if you take an exemption, then up to rupees 5 lakhs, in any case you don't have to pay the tax even under the old system. And this 550, that means up to 10,50,000 apparently, depending upon your earning nature of the income and your various commitment and various financial obligations which you have taken up, there is a probability that you may find after calculation that it is not worth going for a new alternative rate of scheme. Unless and until you are willing to change completely a financial scenario in your family and you are rearranging all the aspects whereby certain obligation you are transferring to some another family member. Legally, if it is feasible, then you may go for an alternative rate of scheme. Otherwise, in each of the case, you have to decide what to be done and what should not be done. Now, let us go for the further exemptions and the deductions which are to be foregone. In the previous slide, I have compared all the exemptions and deductions which are claimed by 80% of the people. So here, another one provision that you will not be allowed to any loss to be carried forward or to be brought forward. Take for example, under the income from house property, there were certain unabsorbed loss, say up to 2 lakhs interest income. Then it will not be allowed to be adjusted in the current year. It will be assumed that it has been absorbed or it has been extinguished. Now generally this loss carry forward is there whenever the property certain interest you have paid under for the under construction property. Then that exemption or deduction also you will have to forego. Then no depreciation can be claimed, obviously from your business income also, but sometimes even the income from other source. Take for example, you have one of the way of investment is you invest in the vehicle. You may be having a salary income, but you invest in the vehicle, and this vehicle you are giving on rent. And this vehicle which you are giving on rent comes as an income from other source. Now on this rent income, you may get a depreciation against this vehicle at the rate of nearly 30% of the cost of the vehicle. So this depreciation also you will have to forego if you are opting for an alternative rate of taxation, which under the old provision, if you follow the old provision and you have got purchase a vehicle of say 10 lakhs rupees, you get the depreciation of 3 lakhs rupees. And if the vehicle is given on rent for say 2 lakhs rupees, then minus 1 lakh loss was adjusted in the old scenario. But here no carry forward, no depreciation, no loss adjustment will be allowed to be done. So this has to be kept in mind. Then additional depreciation also you can not claim whenever you go for an expansion in your business and you purchase a new specified assets. Then income from business and profession will lose number of other benefits which are stated over here, like 32, 32AD, 33AB and number of other such benefits which are available under the existing scheme, and this also you will have to follow. And beside this, there are a number of deductions under chapter 6A available to a businessman whenever he establishes certain businesses under certain circumstances, under certain places. Then all that deduction also has to be foregone. So also newly established SAZ units will benefit, also will have to be foregone by the businessman. This was one of the reasons I said that for the businessman, he has to really think of, especially if he's carrying out a business in the proprietary form or in the partnership form, whether he should go for this new scheme or whether he should not go for the new scheme. But if he's carrying out in the private limited form, it's a separate decision and it can be taken accordingly. Then allowance to MP, MLA under section 1017 also will have to be foregone. And there is one general line. Without any exemption or deduction or allowance of perquisite by whatever name called provided under any other law for the time being in force, that also has to be foregone. Now there are a number of exemptions and deductions which are available to the assessee, not under the income tax law, but under the various law which has been coming from time to time. Take for example one very well-known thing at this particular moment in the COVID situation. A PM Care Fund was created, and they made an amendment that if you are making any contribution up to 30th of June 20, then that contribution you can claim in the return of 1920. But if you try to claim it under the return of 2021, because of this, and you go for an alternative rate of tax, you will not get this particular deduction. This is one of the exemptions. There is another exemption also available. Take for example, if the land has been acquired by the government and you get certain capital gain, then that is under certain situation is also exempted, not as per the Income Tax Act, but as per the Land Acquisition Act. Then that exemption or the deduction also you will have to be forego, because there is a general line which has been saying that without any exemption or deduction for allowance or perquisite by whatever name called provided under any other law for the time being enforced. So that means you have to forego all the benefit, deductions, exemptions, even under the other law, not only restricted to the income tax law. Now this is a very sweeping statement, and one has to really take care of when he opts for an alternative rate of tax. Now this benefit continues. So there are a certain good silver lining, and this is even after opting for the new scheme. And there are 50 such benefits which do continue. One is a standard deduction on the rent. So if you are giving a property on rent and you are getting a rent income, then the 30% standard deduction available will be available even under the new alternative scheme as well as under the old scheme. Then agriculture income, if you are disclosing an agriculture income, then also that benefit continues. Then if you have received an amount from the LIC, and if it is within the 10% annualized premium and paid not by a single premium, then that exemption also continues. Then if you are getting a retrenchment compensation up to rupees 5 lakhs, that benefit continues. If you are getting a VRS proceeding of rupees 5 lakhs, that benefit continues. A leave encashment on the retirement, rupees 3 lakhs, as far as the government employees is concerned, there is no limit. So that benefit also continues. Or employer contribution on account of the employee in a notified pension scheme, then that benefit also continues. The deduction under the 80JJA for a new employment created by the businessman, that benefit is available and that also continues. If the individual or HUF has got a unit in the International Financial Service Center under the SAZ, then that benefit also continues as such. Then you don't have to pay the minimum alternative tax which a businessman is required to pay. And because this is benefit, they have very clearly stated by amending that particular provision that if you are opting for the new scheme, you don't have to pay the minimum alternative. So question is, who should go for the new alternative rate of tax? This is a conclusion part. But at the same time, before I go into the individual general conclusion, again I request you kindly go through the deductions which you have to forego, recalculate your income and then select the scheme. But by and large, if you are a young person, a fresher in the service and you are happy-go-lucky, no commitments, you can definitely opt for this particular new alternative rate of tax and pay lesser tax. If you have no investment or no loan and you are a very contented fellow, then also no problem, opt for the alternative rate of new scheme. If you are a self-centered person, then also you can go for a new alternative rate. Or if you are a good senior citizen, then you can also go for a new scheme. Or you are a retired person, but this is in generality. Now, what are the specific conditions for each of them? Let us understand that. That here, when I say you are a carefree or young person, and you don't have any professional or business income, and you don't have any investment or any loan liability because you just started, no one has given you the loan, nor you have got a surplus money available for investment. In that case, you should go for the alternative rate of scheme. Your investment is lesser and you are not taken up any loan for purchasing the house, then you also should go for this particular scheme. Or you're on the sufficient money that you don't require any loan. You don't get any perquisites. There are no investment future plan. You want to just spend your money, whatever you are getting, for yourself. And there is no education loan required because your children are either settled, or I should not say. Then in that case, you can go for this alternative scheme. Or you are well settled and very contented in your life. And you also will like to contribute some taxes to the government because you want to help the country to progress. Then you should also go for an alternative rate of scheme. Or if you are a retired person, no opportunity of getting any further loan, no incentive for saving for the children as they are well settled, no educational loan, no any further plan for your business or the growth, and your retired income is below rupees 15 lakhs, then definitely you should go for an alternative rate of tax. So you will have to decide in each of your individual case. Thank you. Still there are few questions which you feel has not been answered by me and which are there in your mind. I am here to share my knowledge with you, and you can definitely post me a query on the given email ID and I will try to respond as early as possible on the same. But there is a probability that either you disclose a complete fact or I will have to ask for the complete fact before I give a response or suggestions for you in a particular case. Thank you very much. Thanks very nice for listening to me, and I hope I've satisfied uh, things which were there on your mind. Otherwise, you can definitely ask me the query through mail. Thank you very much.